So joining us now for more on today's market action, we have Ann Sonders, Chief Investment Strategist at Charles Schwab. And Ann, when we try to make sense of what's going on in the market, we have new highs today in wake of the coronavirus threat, also that warning from Apple yesterday. When you try to kind of just determine what all this means, the market so far has been taking this in stride. Do you think that's going to change anytime soon?
You know, as far as the coronavirus is concerned, I'm no more an expert on this in terms of the potential duration that this lasts and ultimately what the ripple effects are. I mean, we heard obviously from Apple and as a bellwether, I think that gave some indication of the hit. But I think the market is clearly looking at this as fairly short term in nature and the possibility that we get a rebound. I think, one of the differences, though, when people do the appropriate comparison between the coronavirus and SARS in 2003 is to judge how quickly you get that economic rebound. The difference, though, is that relative to 2003, China's weight in global GDP has more than doubled, and the power of their consumer in terms of global multinational corporations on the consumer side, not least being those in the United States, is up multiples of that as well. So I think that's the important difference. If we can contain the weakness either broadly in the economy or specific to earnings to say the first quarter, the market's probably fine. There's enough momentum. But I think there is some risk of a bit of complacency here with regard to the ultimate impact of the virus.
Lizanne, when we take a look at where markets are right now at record highs for the S&P and the Nasdaq, when we talk about market sentiment, do you think it's stretched at all at this point?
Well, sentiment's been an interesting animal in this entire bull market. Arguably up until the beginning of 2018, sentiment really never got to anything resembling euphoria, which I think is one of the reasons why this has been such an elongated bull market. It's been climbing that wall of worry. There was sort of a default position of skepticism. Beginning of 2018, you started to see some of that traditional euphoria. It got kind of knocked back with the short vol implosion in early 2018, of course, the near bear market in the latter part of 2018. Recently, you did start to see some real extremes in terms of optimism, particularly in behavioral measures of investor sentiment in mid-January. And then we got that kind of knocked down a bit with the outset of the coronavirus. But it was only about a 3.3% pullback in the S&P that was enough to bring those sentiment measures down at worst to neutral. So what I think is unique in this very recent period of time is it doesn't take much of a pullback in the market to bring back some of that euphoria. And I think that has been, at least in the near term, a bit of a stabilizing force. I'd rather it be that way than, say, the late 1990s, where no matter what the news was, no matter what the market did, investors were in that euphoric mode. It was, this time is different. It's a new paradigm. So that skepticism that comes back more quickly is actually a relatively healthy situation.
Lizanne, what do you make how do you make sense of all this frenzy in terms of some of these momentum names in the market, just in terms of, do you think there's any justification for that, or is it more so just a crowded trade at this point that could lose some enthusiasm in the short term?
Well, obviously, it goes name by name, and I don't cover individual securities, so I'm not going to opine on which ones I think might have more momentum and don't. It's not what I do. But this is what happens in a momentum-driven market. In a perfect world, there would be less narrowness than what we're seeing right now. But we know that there's increased trading activity on the part of institutions, certainly many institutions that came into this year short many of the high momentum names. So you've seen that added short covering. You've just got the power of that momentum trade. As we know from many times over the decades, momentum can last for a long time, and it can persist until it doesn't anymore. And it's hard to judge, other than with the benefit of hindsight, when that sort of point comes where the momentum ends, either because it's catalyst-driven or it's sentiment and euphoric-driven. For now, though, that's clearly where the money is going. But what's interesting about the leadership this year is it's not just confined to the big, well-known tech names, which clearly have maintained their leadership position. But year to date, the two best performing sectors. One is tech, but the other is utilities. So it's a bit of a bifurcation in terms of what investors are looking for. There's that component of money that wants to chase that momentum, that likes the growth characteristics associated with that. But there's also, I think, sort of a cohort or a pool of money that is looking for yield, looking for income, especially in this recent period where you've seen the move back down in the 10-year yield, the reinversion of the yield curve. So it's just an interesting pairing of tech and utilities being at the top of the performance spectrum.
Yeah, listen, I wanted to talk to you about that just in terms of the bifurcation that we are seeing in the market. With that positioning in utilities, do you think that's, I guess, a chance or maybe some investors trying to get a little bit more defensive in their portfolios at this point, just in terms of hedging against any sort of significant pullbacks that we could have in the short term?
I think maybe some investors are moving into an area like that for defense, but I think probably more of it is the yield grab, because you're seeing that not just in those sectors that generally have higher yielding securities, but across the spectrum of bond proxies and other areas within the corporate debt area where you can see a pickup in yield. So I think we're back in that mode on the part of investors of sort of desperation for yield at kind of any cost. One of the interesting things about utilities, and it maybe is an example of why, although we will make tactical recommendations on cap, we've been overweight large cap and underweight small cap for 3 years now, we don't do the same on growth and value, because I think there's an important difference between the fundamentals of growth and value and the index labels of growth and value. Utilities are still housed in most of the value indexes, depending on what tracker you're looking at. But right now, because of how well they've done, it's actually hard to argue that they offer a lot of fundamental value. They're fairly rich from a valuation perspective. They just happen to still be in the value indexes. Russell, for instance, is not going to move them into the growth indexes. So I think it's really important for investors to, at times in particular, differentiate between, are we talking about the fundamentals of growth and value or the index labels of growth and value? There's often very different things.
Lizanne, we had the producer price index coming out this morning. It was a 0.5% increase. Some investors or some market watchers, I think, were a little bit surprised by this. In terms of when you drill down just as far as what it could mean for the markets, does this mean that, or does it suggest, I should say, that some inflationary pressures may be building in the market at this point?
Well, I think it's an interesting analysis that we have to do. Anytime a consensus builds that is so uniform about a subject, and I think that has been the case with regard to inflation. I think the consensus is adamantly that inflation is dead and buried forever. And, you know, the devil's advocate in me says, okay, what could maybe tip that in the other direction? And I think inflation maybe being a little bit more of a risk, not just in the very near term, but thinking longer term. You know, if you think about the last 20 or 30 years, this disinflationary environment that's been to the great benefit of asset prices and investors, a lot of that has been a function of globalization and the implications of globalization. Well, if this move globally, not just by the United States, away from globalization toward protectionism, toward nationalism, and then you add to it the rejiggering of supply chains that initially was a function of the trade war and then more recently a function of the virus. And if this deglobalization, to think of it broadly, is not just cyclical but more of a secular trend, you have to wonder whether that maybe is a bit more inflationary, not hyperinflation, not 1970s style, but maybe a bit north of that very pat consensus view that it's something we don't have to worry about at all. I'm not sure if today's PPI report is a symbol that that is imminent, but I just think I'm always more intrigued by the story no one is telling than I am the story everyone is telling. So I just think it's something to, it's kind of something to have as a bee in our bonnet.
That's very interesting. All right, Ann Sonders of Charles Schwab, thanks for joining me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.